The silver shock, how a metal nobody cared about became the most dangerous trade on Earth. Imagine waking up one morning to find that the spoons in your drawer are worth more than your car. Not as scrap, as speculation. Because overnight, silver, boring, industrial, grandma's tea set silver, just became the most violently traded commodity on the planet. The price didn't creep up, it exploded. We're not talking about a nice 10% rally that makes investors smile. We're talking about moves so sharp, so sudden, that trading platforms froze, brokers raised margin requirements mid-session, and retail traders watched their accounts get liquidated in real time, while billionaires made more money than small countries. In early 2025, silver went from roughly $30 per ounce to briefly touching levels that made even gold bugs blink. Then it crashed. Then it surged again. Then exchanges stepped in. Governments started asking questions. And somewhere in the background, a few very quiet people made generational wealth, while everyone else tried to figure out what the hell just happened. This isn't a story about precious metals. This is a story about leverage, liquidity, and what happens when a market too small to matter suddenly matters more than anything else. Welcome to the Silver Squeeze, the trade that broke the rules, and the question nobody's answering. Is this over, or has it only just begun? 1. The forgotten metal. Why nobody cared about silver until they did. Let's start with the basics. Silver is not sexy. It never has been. Gold gets the mythology. Gold is kings, empires, central banks, fear, power, immortality. Gold is what you buy when civilization is ending. Silver? Silver is the stuff you use to coat solar panels, make batteries, and fill the back of your grandmother's china cabinet. For decades, silver traded like industrial scrap with a pulse. Investors barely glanced at it. Why would they? Gold was the safe haven. Copper was the economic indicator. Oil moved markets. Silver just existed. Boring, predictable, industrial. Then something changed. Not gradually, suddenly. The setup, a market too small to defend. Here's the first crack in the facade. The entire global silver market, mining, refining, industrial use, investment demand, is shockingly small. Annual global silver mine production sits around 800 to 900 million ounces. Sounds like a lot until you realize that's only worth about $25 to $30 billion at $30 per ounce. Compare that to gold, which moves $200+ billion annually, or oil, which trades trillions in derivatives alone. Silver is a rounding error in global finance, and that's exactly why it became a target. Because when a market is small, it doesn't take much money to move it. And when leverage is involved, you don't even need that much money. You just need conviction, coordination, and a spark. The Reddit awakening. Wall Street Bets goes shiny. In early 2021, a subreddit called Wall Street Bets became famous for coordinating a short squeeze on GameStop stock. Hedge funds had bet against GameStop. Retail traders bought massively, forcing short sellers to cover at inflated prices. The result? Billions in losses for institutions, billions in gains for individuals who got out in time, and a cultural moment. Then someone asked a dangerous question. What if we did this with silver? The logic was simple and terrifying. Silver is heavily shorted through paper contracts, futures, ETFs. Physical silver supply is tight. If retail investors bought physical silver and silver ETFs aggressively, they could trigger a supply crunch and force short covering. It was GameStop, but for a commodity market older than the United States. The establishment laughed. Then the price started moving. The first spike, when memes met metal. In early 2021, silver jumped from around $25 to nearly $30 in a matter of days. Reddit forums exploded. Hashtag Silver Squeeze trended. Coin dealers sold out. Premiums on physical silver bars and coins skyrocketed. Not just 5% or 10%, but 30 to 50% over spot price. This wasn't a normal market. This was panic buying meets speculative mania meets distrust of the financial system. And here's the critical part. It worked. Not because Reddit controlled the market, but because they exposed a structural weakness. Silver's price is set by paper contracts traded on exchanges like COMEX. But the amount of silver represented by those contracts vastly exceeds the amount of physical metal available for delivery. It's a fractional reserve system for commodities. And like all fractional reserve systems, it works perfectly until everyone asks for their money back. Or in this case, their silver. 2. The leverage bomb. Why silver moves like a penny stock on steroids. Now let's talk about why silver doesn't just rise, it detonates. The answer is leverage. In commodity markets, you don't need to buy the full value of what you're trading. You just put up a fraction, called margin. For silver futures, that margin can be as low as 5 to 10%. Translation: with $1,000, you can control $10,000 to $20,000 worth of silver. If silver goes up 10%, you don't make 10%. You make 100 to 200%. But if it goes down 10%, you don't lose 10%. You lose everything. And then your broker sends you a bill. The margin call massacre. Here's what happened in early 2025. Silver started climbing. Not slowly, fast. $30, $32, $35. Retail traders, emboldened by 2021 nostalgia and new narratives around industrial demand, solar, EVs, AI data centers, piled in. Leverage was maxed. Then, without warning, exchanges raised margin requirements. Overnight, traders who were comfortably leveraged suddenly needed to deposit more cash to hold their positions. Many couldn't. Brokers liquidated positions automatically. This triggered a cascade of selling. Price dropped violently. Stop losses triggered. More selling, more margin calls. The classic death spiral. But here's the twist. While retail got crushed, institutional players who knew the margin hike was coming quietly accumulated at lower prices. By the time the dust settled, silver had whipsawed 15% in both directions within 72 hours. Fortunes were made. Fortunes were destroyed. And the average person still had no idea silver was even tradable. The paper versus physical divergence. During the chaos, something bizarre happened. The spot price of silver, the paper price, dropped. But physical silver, coins, bars, bullion, became impossible to buy at spot. Premiums exploded again. Dealers were quoting $40 to $45 for silver, trading at $32 on the screen. Why? Because paper and physical are not the same thing. Paper silver is a contract, a promise, a derivative. Physical silver is atoms. It has to be mined, refined, transported, stored. You can print infinite paper contracts. You cannot print silver. This divergence revealed the lie at the heart of commodity pricing. The price you see is not the price of the thing. It's the price of a bet on the thing. And when those two prices separate, someone is getting robbed. 3. The industrial demand time bomb. Why silver isn't just shiny anymore. For most of history, silver's primary use was monetary and decorative. Coins, jewelry, silverware. That changed in the 20th century. Silver became industrial. And in the 21st century, it became critical. The green energy trap. Here's the uncomfortable truth the renewable energy movement doesn't advertise. Solar panels need silver. Every single photovoltaic cell uses silver paste to conduct electricity. As the world races toward net zero carbon emissions, solar installations are exploding. The Silver Institute estimates that solar panel production alone now consumes over 100 million ounces of silver annually, roughly 10 to 12% of total global supply. And that number is rising fast. By 2030, some projections suggest solar could consume 15 to 20% of annual silver production. Now do the math. If supply is capped and industrial demand is structural and growing, where does the price go? Up, unless someone finds a substitute. But here's the problem. They've been trying to substitute silver in solar for 20 years. Progress is slow. Why? Because silver is the best electrical conductor that's economically viable at scale. Copper is cheaper but less efficient. Gold is better but absurdly expensive. Silver is the Goldilocks metal, and the world is running out of porridge. The EV and AI multiplier. It's not just solar. Electric vehicles use more silver than combustion engine cars. Data centers, AI chips, 5G infrastructure all use silver. The electrification of everything is also the silverization of everything. And unlike gold, which central banks hoard and nobody uses, silver gets consumed. It goes into products. It gets buried in landfills. It doesn't come back. This is a deflationary supply story hiding in plain sight. And it's why some analysts argue we're not in a speculative bubble. We're in the early innings of a structural supply deficit. The conspiracy that won't die is silver being suppressed? Okay, deep breath. We're entering the part of the story where serious economists roll their eyes and Redditors start typing in all caps. The claim, silver's price is artificially suppressed by a coordinated effort involving central banks, bullion banks, and futures exchanges. The motive, to protect the dollar's dominance, prevent inflation signals from going mainstream, and allow industrial users to source silver cheaply. The evidence, circumstantial, contradictory, and maddeningly persistent. The COMEX paper shuffle. Here's the allegation. The COMEX Futures Exchange allows entities to sell silver contracts they don't physically have. These naked shorts flood the market with paper supply, suppressing price. When buyers demand delivery, the exchange offers cash settlement instead, or points them toward a limited pool of physical metal. If true, it's price manipulation. If false, it's just how commodity markets work. The problem? Both can be true. Futures markets are designed to allow hedging and speculation without physical delivery. That's not a bug, that's the feature. But when the ratio of paper claims to physical metal exceeds 100 to 1 or even 200 to 1, estimates vary wildly, the system becomes a powder keg. One large entity demanding physical delivery could implode the whole structure. The Hunt brothers' ghost. This isn't theoretical, it happened before. In 1980, the Hunt brothers tried to corner the silver market. They bought physical and futures contracts aggressively. Silver went from $6 to $50 in months. Then the exchange changed the rules mid-game. They raised margins, restricted buying, allowed selling only. The Hunts were crushed. Silver collapsed. The lesson regulators learned: never let a squeeze succeed. The lesson traders learned: the game is rigged, but the rig has cracks. And every few decades, someone tries again. 5. The 2025 surge. What actually happened? So what triggered the recent explosion? Not one thing, a perfect storm. The macro backdrop. By late 2024, the world was a tinderbox. Inflation was sticky. Central banks were stuck between raising rates, killing growth, and cutting rates, fueling inflation. The dollar was volatile. Geopolitical tensions were high. Investors were looking for real assets, hard assets, anything that couldn't be printed. Gold was already expensive, hovering near all-time highs. Silver looked cheap by comparison. The gold-to-silver ratio, a measure of how many ounces of silver it takes to buy 1 ounce of gold, was sitting around 80 to 1. Historically, it averages closer to 60 to 1. Some argue it should be 15 to 1 based on natural occurrence in the Earth's crust. Suddenly, silver looked like a coiled spring. The catalyst, a rumor, a shortage, a squeeze. In early 2025, reports surfaced of tightness in physical silver markets. Mints were running low. Refineries were backlogged. Delivery delays stretched from days to weeks. Then came the rumor. A large institutional buyer, some said a sovereign wealth fund, others said a billionaire, others said a coalition of funds, was taking massive physical delivery from COMEX. Whether true or not, the market moved like it was. Silver spiked, retail piled in, leverage amplified, exchanges panicked and raised margins, volatility exploded. And just like that, silver wasn't boring anymore. It was the most dangerous trade on Earth. 6. The casualties. Who got crushed? Let's be clear. Most people lose money in volatile markets, not because they're dumb, because the game is designed that way. The retail trader wipeout. Thousands of retail traders bought silver futures, options, or leveraged ETFs near the top. They believed the squeeze narrative. They thought this time would be different. Then the rug pull came. Margin hikes, liquidations, stop losses triggered in milliseconds. Accounts zeroed. Some lost savings, some lost more than they had. Brokers sent bills for negative balances. These weren't criminals. They were people who believed in a story and got caught in a machine built to extract wealth from belief. The dealers who couldn't deliver. Physical silver dealers faced their own nightmare. They sold coins and bars at locked-in prices, expecting to source inventory from wholesalers. But wholesalers were out of stock. Spot price was moving faster than supply chains. Some dealers honored contracts at a loss. Some delayed shipments. Some refunded orders. Trust evaporated. The divergence between paper and physical became a business crisis. 7. The profiteers, who made billions. But someone always wins. Follow the money. The bullion banks. Banks that hold large physical inventories in trade derivatives, they saw this coming. They know the structure of the market. They know when margin hikes are coming. They can hedge, arbitrage, and profit from volatility itself. When retail panics, institutions collect. The mining companies. Silver miners saw their stock prices surge, not because they produce more silver, mining output doesn't change overnight, but because the value of their reserves skyrocketed. A company sitting on 100 million ounces of unmined silver just saw its asset base explode. Shareholders got rich, executives got bonuses. The quiet accumulators. And then there are the ghosts, the entities that don't tweet, don't appear on CNBC, don't explain themselves. They just buy, quietly, relentlessly. They bought physical silver when it was $18. They bought at $25. They bought at $30. And when it spiked to $40, they didn't sell. Because they're not trading, they're acquiring. Who are they? Maybe sovereign wealth funds hedging currency risk. Maybe family offices buying hard assets. Maybe someone who read history and decided that silver, like gold, is the ultimate insurance policy. We don't know. We just see the supply disappearing. 8. The endgame. 3 scenarios. So where does this go? Nobody knows, but here are the 3 paths. Scenario 1, the squeeze fizzles. Exchanges tighten rules. Regulators investigate. Retail loses interest. Price bleeds lower. Silver returns to $25 to $28 range. Industrial demand absorbs supply. Life goes on. The conspiracy theorists were wrong. It was just a speculative spike. Nothing structural changed. This is the consensus view. Scenario 2, the slow burn. Industrial demand continues to rise. Supply stays flat or declines. Many silver mines are aging. Price grinds higher over years. No fireworks, just a steady, relentless bid. Silver hits $50 by 2028, then $75 by 2032. Not because of a squeeze, because the world actually needs it. This is the boring bull case, and it might be the scariest because nobody sees it coming. Scenario 3, the break. A major entity, government, fund, billionaire, demands physical delivery on a scale COMEX cannot meet. The exchange offers cash settlement. The entity refuses. Legal battles, Media firestorm. Confidence in paper silver collapses. Price explodes to $100, $150, $200. Governments step in. Markets freeze. New rules are written. And silver becomes what gold once was, a geopolitical weapon. This is the catastrophic scenario. Low probability, infinite consequences. 9. Final thoughts. The metal that wouldn't stay boring. So that's the story. Silver went from the back of your grandmother's drawer to the front page of financial panic. Not because it's rare, it's not. Not because it's useful, it always was. But because it sat at the intersection of leverage, liquidity, industrial demand, and distrust. And when those four forces collide, price doesn't move. It detonates. Here's the uncomfortable question. Is this a market or is this a game? And if it's a game, who wrote the rules? The people buying physical silver believe the system is broken, that paper contracts are a lie, that real assets are the only truth. The people trading futures believe markets are efficient, that price reflects reality, that volatility is opportunity. Both can't be fully right, but both can be fully ruined. Silver didn't just spike because people bought it. It spiked because people stopped trusting the price. And when trust breaks in financial markets, what's left isn't investing, it's survival. The commodity nobody cared about just became the trade nobody can ignore. Whether you think it's a bubble, a squeeze, or the start of something bigger, one thing is certain: silver isn't boring anymore, and it may never be again. If you want to understand what happens when the next metal breaks, lithium, cobalt, nickel, or when the commodity markets finally snap under the weight of their own leverage, watch for the next video. And yes, subscribe. I'm still trying to figure out if I should have bought silver or just stuck with gold. Thanks for watching. See you in the next one.